with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I just put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, October 3rd, 2025. Let's just go ahead and jump right into the numbers. Look, the market surprised me this week. It surprised me. It pushed higher. It looked like we were starting to soften up a little bit last week. Maybe the market was going to pull back, and then it just went the other direction. Why, you ask? Well, maybe it's because the government shut down. maybe the market is happy about it, right? If there's no one sitting in Washington, D.C. to make bad laws, then you have a little bit less to worry about, maybe. Okay, I'm being facetious. We'll talk more about the government shutdown in a minute because there are some issues to be concerned about there. Let's go talk about the numbers, though. Dow Jones this week up 1.1%. The S&P 500 up 1%. The NASDAQ up 1.3%. And the Russell Small Caps moving the most, up 1.7% this week. We'll talk about why in just a moment. Volatility index as measured by the VIX up a bit this week, up 8.8%. And want to keep a close eye on that. If this pushes a little bit higher, there's a couple of things that could unravel here. We'll talk about that as well. Looking at long-term bonds as measured by the TLT, that's a basket of long-term bonds traded on the stock exchange, up 0.5% on the week. And when you look at all the different sectors, the big movers this week, semiconductors up 4.6%, utilities up 2.4%, healthcare having a monster move this week, up 6.8%. And look, I think, not to jump off and get into the nitty-gritty too soon here, but I think some of this has to do with the Pfizer deal. We've got Pfizer in our models. We bought it towards the end of last year. It was paying a 7% dividend. I feel the stock is undervalued. And if we can collect 7% in dividends while we wait for the stock to pop, that's a pretty good setup, in my opinion. I mean, if it's 1 year, if it's 10 years, if you get 7% a year, your money doubles every 10. And then if you get a 20, 30, 40, 50% move on top of that, that's a great situation to be in. So the CEO over there has been turning some things around, trying to get that company heading the right direction since COVID. And that's why we bought it. Well, this week, there's a big announcement made with Pfizer, with the federal government, where Pfizer is agreeing to give the United States the favored nation status when it comes to drug pricing. And you would have thought that maybe would have sent the stock down because that means lower prices for Pfizer drugs in the United States. But the stock was up 15% on the week, carrying some of the other healthcare stocks with it. And why would that be? Well, a couple of things. One, it's going to exclude them from the 100% tariff that was just announced last week. So they're going to be excluded from those tariffs because of this deal, while they also move to open up some manufacturing facilities here in America to avoid the tariff in the future. And then secondly, I got to thinking about it. The market's kind of smart. It sniffs things out. If the United States is added into the favored nation status at the same price as everyone else around the world, what's one of the ways you can offset that? Think about it for just a moment. You can just raise the price for everybody. So maybe it could be a situation where the price comes down for America, goes up for everybody else. And when you put it all together, getting a little bit more from a much larger pie could actually be more revenue than soaking the United States. So maybe that's going to work out. Maybe that's why Pfizer was up so much on this news this week. But that definitely drove healthcare up, that's for sure. As far as the bad sectors, energy. Look, remember I said last week, energy had a good week last week. And I said, I don't know, that's going to stick. For the next 6 to 12 months, I think energy could be a little bit tepid here. Well, it was down 3.3% this week, so it didn't hold up too well. There's some talk about OPEC increasing production here going into November. Communication services are down a little bit this week. Gold and silver continue just to push higher. Gold up 3.1% on the week. Silver up 3.9% on the week. So gold just continuing to be very, very constructive. And of course, our gold miner riding that sentiment as well. So what's moving markets? Well, I mentioned the healthcare thing. That was kind of a big deal there. And healthcare really kind of drove things for quite a bit this week. Outside of that, look, the shutdown, there is some things to talk about as far as how they relate to how the market's reacting. Because of the government shutdown, we didn't get data this week. We were supposed to get a jobs number this week. And that jobs number could have been a really impactful number because if the number was hotter than expected, in other words, a better jobs number than what maybe was anticipated, that could put more doubt of the Fed cutting interest rates in a few weeks. And look, the market is pricing in a 90% probability of 2 more cuts. I've been watching the Fed speak here pretty closely. When I say the Fed speak, we're talking about all the different Fed governors. There's a lot of folks that are still talking about the inflation situation. It's remaining sticky. Austin Goldsby, he's one of the more, I say, even-keeled Fed members. He was on CNBC just this morning, and he highlighted something that's concerning me. I mentioned it a few weeks ago. It's services inflation. Services inflation, right? We're not talking about products and goods. We're talking about services. The tariffs, what do they have to do with services, right? Not much, not at all, probably, when you really think about it. So with services inflation being sticky, that's a concern. And the Fed, as I mentioned, Jay Powell said it himself. I've heard other Fed folks reiterate, they're in a sticky situation. They're in a really between a rock and a hard place. Look, you don't want jobs to go over the cliff. You don't want the economy to slow down. A lot of the economic numbers look pretty strong, like GDP, things like that. Only the labor numbers seem to be pretty weak right now. And then you don't want inflation to rear its ugly head and really start to take off. And services aren't related to tariffs. So what's going on there? And the Fed's got to be concerned about that. If they get too aggressive at cutting rates, inflation starts to spiral out of control again, we've got a big problem on our hands. So this is starting to look a little bit, I hate to say it, but a little bit like a stagflation situation, although the growth of the economy still is pretty resilient. If that starts to slow and inflation remains sticky, then you've got a stagflation, right? You've got a slow economy with high inflation. That's a really ugly situation to be in. We're not there at all, but these are things to watch. So the market, I think, responded very positively because it didn't get data. The government was shut down, no jobs number, no economic data being released by the government. Therefore, the market thinks, hey, there's nothing to change the narrative. The Fed should stay on track to cut rates. And that's why it responded. And that's why small caps were up so much this week. Okay, that's why they responded so positively. So that's what's going on there. About the shutdown, look, there's more data to be released. Will we get it or not? There's a couple of big inflation numbers that are to come. The consumer price index, the producer price index, CPI and PPI. Will we get them? I don't know. That's going to be interesting to see how the market reacts. If we don't get anything, I think the market's going to assume the Fed's going to cut again because there's nothing to upset the narrative. But here's another thing that's got me a little bit concerned, and it's just the politics and how politics can then play into the economics. Everything that I'm reading says the government being shut down for a few days, folks are going to look at it and they're going to probably put the angst on the Democratic Party at the moment. But if they stick to it and they don't bend and they continue to allow the government to remain shut down, pundits are saying that the consumer sentiment will start to shift and they'll start to come back to the other side and they'll start putting pressure on the GOP and the president to do something to get things up and running again. So it's going to be interesting to see how it plays out, if the Democrats will hold out or not. I hope they don't. Look, we have to have a functional government. We need to be up and running. This is really ridiculous. As I mentioned before, this is nothing but a bridge bill, right? This is just to get us from point A to November. We're not talking about solving all of our country's problems with this bill. The heavy lifting still has yet to be done. That's still a November deadline. So we'll see what happens here. But if they decide to just hold out, and listening to some of these pundits thinking that the blame will start to shift if they hold out longer, if this starts to set up as a longer term type of shutdown and people don't get paid, now you're going to start to have problems with the economic growth and it's going to start to bleed into GDP. And we got some other issues. So these are all things that we're being mindful of and keep an eye on. Aside from that, the technicals have been a little bit interesting. This market has just been unbelievably resilient. I've mentioned it before. I'll say it again. It surprised me on a couple of occasions. Luckily for us, we've been engaged. We're having a great year. I mean, just a huge year, far and away above the benchmark. So I'm very happy with where we sit. We're not running behind like a lot of the industry is. But the technicals have just been a little out of sorts. They flash sell signals and then it doesn't happen. They get negated. This past week, we had some DeMark signals get negated because the market pushed higher. But there is a weekly sell signal on the DeMarks, not a daily, but a weekly. And that could indicate that if we do start to roll over, we could be in store for a little bit of a longer period of market digestion, consolidation, maybe a little bit of a downward move. So that's something to be mindful of. I've been talking to one of our lead technical strategists that we work with, and really the 20-day moving average has been a key thing to watch. Everything else has been kind of thrown out the window this year, but when the 20-day moving average tends to roll over, things do tend to get sloppy in the market. So we've got all eyes on that right now. It's been holding pretty steady and continues to push higher. But if that starts to roll over, then that could be a signal that there might be a little bit more pain to come. But look, right now, we're just kind of floating, waiting for news to start to come in. We're going to have some earnings next week that are still this past quarter's earnings, but they're going to reflect a little bit here of this next quarter. We'll get a little bit more insight before earnings season kicks into high gear here in another week and a half or so. So we'll be watching all of that as well. For money management purposes, we're kind of holding pat right now, not making any major moves. We've made our moves. We're in a great position. As opportunities arise and stocks drop here and there, we're working in new money for new clients or folks that have added money in recent weeks and get that worked into the models. So that's where we are. Things look pretty good here. Just kind of waiting to see how things unfold here with Uncle Sam. But other than that, I think we're in a great shape. There's going to be a mad chase. A lot of folks are predicting a really mad chase in the market towards year end, because a lot of our industry is way behind. They missed the move in the market. They all got scared in April. They didn't get reinvested, and they're way behind. So a lot of times when you see something like that, you see a chase into year end, the market pushes quite a bit higher. Hey, we're not behind, so bring it. We'd love to take advantage of that and make some more money, but we are a little bit better positioned at the moment for weakness in the market, because if everyone's looking for one thing to happen, maybe something else will shape up. So we want to be prepared for that. We are. So between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe start your own foundation, Jeff. Great conversation with you this week. Hey, maybe it is buy that second house, retire a little early. You know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.